Our trade balance, which most likely will be a deficit, and indeed it is for the month of July, minus 54 billion, 54 billion. And of course, that negative 54 billion is about $1 billion heavier than we were expecting. We were expecting a number a little lighter than that. Rear view mirror, a slight revision, minus 55.2, now stands at minus 55.5. So sequentially, we've lost $1.5 billion. At least with reference to history. Of course, all eyes are continuing to focus on what's going on with interest rates around the globe, whether it's Italy's dropping rates or the UK or the US, of course. New cycle low for 10-year notes yesterday. They went from a little over 147 to pretty much a little under 147 in terms of their closing yields, and that's all I really look at. Intraday are exciting, but what goes into the history books are closes, and that was the lowest close, of course, since May of, 2016, from July of 2016. And also remember, July of 2016 is noteworthy for something else. That was the second of two double bottoms, July of 2012, July of 2016, right around 137. So, of course, we're all going to focus in on that. It does seem as though there will be a test. It's just a matter of when. Andrew, back to you.
Rick, thank you for that. Steve Liesman is here, and he is looking very studiously at his
do you guys remember when we ever spent any time within the international trade data? It's now very, very important economic data, very important political data. And I'll tell you what I went right to was the trade balance with China. Before I get to that, I just want to give you very quickly the overall, which is that exports were up 0.6%, imports down just a little bit. And it may be that the reason why we have a little bit higher trade deficit is because of people trying to jump in ahead of the tariffs. Let me tell you what happened here. Exports to China fell 3.3%. Imports from China rose 6.4%. So that kind of spike, depending upon whether or not those are potentially tariff-affected goods, maybe people trying to get in ahead of these tariffs that come in. We've had this jumpiness in the trade data. So what I did is I looked at trade year to date. Very quickly, I want to show you. One way of looking at this shows the U.S. winning the trade war. And what I looked at was the first half of 2019 versus the first half of 2018, year to date through June. This is not today's data. And it shows that imports from China have fallen by 30 billion, whereas exports to China have only fallen by 12 billion. It looks like a win, right? Not when you look at it in percentage terms, because the Chinese imports are so much larger. Chinese imports are only down 12% versus U.S. exports down 19%. So this is the problem of economics we're going to talk about in a second. I'll give you on the one hand, we're winning in dollars. On the other hand, we're losing as a percentage. Let's take a very quick look at where the winners and losers are. Who took the biggest hit? Computer electronics from China down 22% in this look of year to date. Agricultural down 20%. Machinery down 6%. These are U.S. exports to China. Transportation equipment. I think that's Boeing. And by the way, one thing to think about in the manufacturing data from yesterday, plus the export data, I don't know how what's happening with the 737 MAX figures into this data. A lot of U.S. manufacturing data, Boeing has a big influence on. So we just don't know how to do that. However, you can imagine
their own problems
like its own, right. That's another issue. So that's why transportation equipment may be down. But in any event, very important that agricultural's down, machinery's down on both sides, electric's down here. A lot of people say everybody is losing. Well, you can make your own determination from the data right there.